Hello, everyone, and welcome to Zoom's third quarter fiscal year 2022 earnings release. I'd like to remind everyone this call is being recorded. At this time, I'd like to turn it over to Tom McCallum, Head of Investor Relations.
Thank you, Matt. And let me welcome everyone as well to Zoom's earnings video webinar for the third quarter of fiscal 2022. I'm joined today by Zoom's founder and CEO, Eric Yuan, and Zoom's CFO, Kelly Steckelberg. Our earnings press release was issued today after the market closed and may be downloaded from the investor relations page at investors.zoom.com. Also on this page, you'll be able to find a copy of today's prepared remarks and a slide deck with financial highlights that, along with our earnings press release, include a reconciliation of GAAP to non-GAAP financial results. During this call, we will make forward-looking statements, including statements regarding our financial outlook for the fourth quarter and full year 2022. Zoom's expectations regarding financial and business trends, Zoom's growth strategy and business aspirations to help customers embrace change, enable hybrid workforces, and grow their businesses, product features and the expected benefits of such features, and Zoom's continuing to fortify its position as a leading brand in its industry. These statements are only predictions that are based on what we believe today, and actual results may differ materially. These forward-looking statements are subject to the risks and other factors that could affect our performance and financial results, which we discuss in detail in our filings with the SEC, including our annual report on Form 10-K and quarterly reports on Form 10-Q. Zoom assumes no obligation to update any forward-looking statements we may make on today's webinar. And with that, let me turn the discussion over to Eric.
Thank you, Tom. In the spirit of the upcoming holiday season, I want to recognize the hard work of Zoom's global workforce and thank our customers, partners, and investors for their steadfast trust and support. We continue to fortify our position as a leader brand in our industry. We are honored that Gartner named us a leader in the 2021 Magic Quadrant for Meeting Solutions for the 6th consecutive year, and for Unified Communications as a Service for the 2nd consecutive year. Zoomtopia 2021 was bigger and more successful than ever before. We hosted nearly 34,000 live virtual attendees on our platform and 277 speakers, including customers like Choice Hotels, iLife, and HubSpot. And we did it on Zoom Events, our all-in-one solution for virtual and hybrid events. Zoom Events allowed us to streamline event preparation, enhance audience engagement, and conduct better post-event communication and analysis. Its multi-track functionality enabled us to roll our Analyst Day directly into the Zoomtopia agenda so that participants could move seamlessly across the Analyst Day track, other tracks of Zoomtopia, and the all-connecting lobby. At Zoomtopia, customers shared how they use Zoom to enable flexible co-located workforces and grow their businesses. We demonstrated how Zoom apps, which already had 67 apps after only a few months, has the potential to enhance meeting productivity and collaboration. More and more businesses are building products on our platform that connect interrelated work streams to the Zoom client, both inside and outside of the meeting. We were also super excited to unveil the Zoom Video Engagement Center, which enhances our customers' ability to communicate with their customers through our omni-channel solution, and shows our broader commitment to the contact center space. It's expected to be generally available early next year. Whether it's the ability to virtually whiteboard in and out around the meeting, or utilize AI to transcribe or translate a meeting live, Zoomtopia demonstrated that previously futuristic capabilities have arrived. We're working hard to develop and deploy the technologies of the future to address current business needs and reimagine how we communicate and work in a flexible hybrid world. Now, let me recognize a few big wins for the quarter. We are very excited to have a Carrier Global Corp, the leading global provider of healthy, safe, sustainable, and intelligent building and cold chain solutions, as a long-standing Zoom meetings customer and now a new Zoom phone customer as well. Following several months of extensive vendor reviews of leading UCaaS vendors, Carrier selected Zoom Phone to modernize their phone systems for a large portion of their nearly 53,000 employees across 180 countries. We are so thankful that Carrier chose Zoom to deliver an increasingly comprehensive, secure, innovative, and integrated set of communications services. In addition to Carrier, we had many other upsells this quarter. For example, one of the world's largest global retailers decided to add 20,000 Zoom phone licenses to their existing meetings, rooms, and webinar footprint in order to better manage their global offices, distribution centers, and retail locations. This demonstrates our strong value add to the retail vertical and builds upon previous success stories like Tapestry and Target. We also had several notable Zoom meetings wins in Q3, including a very large expansion for a leading federal system integrator, which puts them at 45,000 users, demonstrating the security and reliability of our Zoom for Government platform. A competitive win with a global technology firm for 16,500 meeting licenses to modernize the way their employees communicate. An expansion within our Big Four audit and Big Three consulting clients, which added more than 35,000 meetings licenses in the quarter to their existing strong meetings footprints. Thanks to our customers, investors, and the hard work of our approximately 6,300 employees, we've grown over the past decade from a video conferencing solution to a communications platform that encompasses unified communications, as well as developer and event solutions. All these services provide an indispensable platform for individuals, enterprises, and developers to connect, collaborate, and build in the hybrid world. And with that, let me pass it over to Kelly.
Thank you, Eric. And hello, everyone. Let me start by reviewing our financial results for Q3 and then discuss our outlook for Q4. In Q3, total revenue grew 35% year over year to $1.05 billion, exceeding the high end of our guidance of $1.02 billion. The growth was primarily driven by strength in our direct and channel businesses, which grew at twice the rate of our online business, as well as improved churn in both online and direct segments. From a product perspective, we saw strong demand for Zoom video webinars, Zoom Room, and Phone. Zoom Phone had year-over-year revenue growth in the triple digits and reached 30 customers with over 10,000 paid seats. The year-over-year growth in revenue for the quarter was driven by a healthy mix between new and existing customers, with existing customers accounting for 26% of the incremental revenue, up from 19% a year ago. Let's take a look at the key customer metrics for the quarter. We saw 94% year-over-year growth in the upmarket as we ended the quarter with 2,507 customers generating more than $100,000 in trailing 12 months revenue. These customers represented 22% of revenue, up from 18% in Q3 of last year. We exited the quarter with approximately 512,100 customers with more than 10 employees, up 18% year over year. In Q3, customers with more than 10 employees represented 66% of revenue, up from 64% last quarter and 62% in Q3 of last year. These trends suggest that our customers with more than 10 employees are expanding their use of our platform, adding more products and seats aligned with our go-to-market strategy. Our net dollar expansion rate for customers with more than 10 employees exceeded 130% for the 14th consecutive quarter as existing customers increased their spend with Zoom, and we saw strong upsells of Zoom Phone and Zoom Rooms. For Q4, we expect this metric to be modestly below the 130% mark, as the denominator of this trailing 12-month metric reflects the significant growth in our customer base. Both domestic and international markets had strong growth during the quarter. Our Americas revenue grew 30% year over year. Our combined APAC and EMEA revenue grew 47% year over year to be approximately 33% of revenue, up from 31% a year ago. On a quarter-over-quarter basis, Asia Pacific had another strong quarter, driven by growth in Australia and Japan, and bolstered by the investments we have made in our international teams. However, as we discussed in Q2, we saw headwinds to our online business in EMEA, mainly related to summer seasonality. Now, turning to profitability, which was strong from both GAAP and non-GAAP perspectives. I will focus on our non-GAAP results, which exclude stock-based compensation expense and associated payroll taxes, charitable donation of common stock, acquisition-related expenses, net litigation settlements, net gains on strategic investments, and undistributed earnings attributable to participating securities. Non-GAAP gross margin in Q3 was 76%, an improvement from 68.2% in Q3 of last year, and stable with Q2 of this year. We remain committed to our multi-year strategy of building out our data centers to support further improvements in gross margin. Research and development expense grew by 169% year over year to approximately $68 million. On a sequential basis, we added over $13 million in R&D expense, primarily due to expansion within our engineering and product teams globally. As a percentage of total revenue, R&D expense doubled year over year to 6.4%, demonstrating our commitment to innovation and product development. Sales and marketing expense grew by 68% year over year to $237 million, or approximately 22.6% of total revenue, primarily driven by increased marketing programs and sales headcount to drive future growth. We remain committed to investing in global sales capacity and marketing across our core and new products. G&A expense grew by 12% to $82 million, or approximately 7.8% of total revenue. This was lower than Q3 of last year as we expanded our G&A functions prudently to meet our new scale. The revenue upside in the quarter carried through to the bottom line with non-GAAP operating income of $411 million, exceeding the high end of our guidance of $345 million. This translates to a 39.1% non-GAAP operating margin for Q3, compared with 37.4% a year ago and 41.6% last quarter. Non-GAAP diluted earnings per share in Q3 was $1.11 on approximately 306 million non-GAAP weighted average shares outstanding. This result is 3 cents above the high end of our guidance and 12 cents above Q3 of last year. This result includes a $70 million provision from income tax, a significant increase from last year, mainly due to fully utilizing our NOLs, as well as a decrease in our stock-based compensation for tax purposes. Turning to the balance sheet. Deferred revenue at the end of the period was $1.2 billion, up 39% year over year from $855 million, and slightly up quarter over quarter. Looking at Q4, we expect the year-over-year growth rate in deferred revenue to be in the mid-20s. This is driven by the cyclical decline in the average remaining term of our annual customer contracts, which are front-half weighted. Looking at both our billed and unbilled contracts, our RPO total approximately $2.5 billion, up 51% year over year from $1.6 billion. We expect to recognize approximately 67% of the total RPO as revenue over the next 12 months, as compared to 72% in Q3 of last year, reflecting a shift back towards longer-term plans. We ended the quarter with approximately $5.4 billion in cash, cash equivalents, and marketable securities, excluding restricted cash. We had operating cash flow in the quarter of $395 million, as compared to $411 million in Q3 of last year. Free cash flow was $375 million, as compared to $388 million in Q3 of last year. It's important to note that as we progress beyond the initial phases of the pandemic growth and continue to invest to support our new scale, our working capital is normalizing. In Q4, we expect to incur a one-time $85 million cash outflow related to a legal settlement, which we disclosed and booked as a GAAP expense in Q1. As a reminder, due to the seasonality of renewals being front-end loaded and tapering through the year, our collections will follow the same trend. We also expect further CapEx investments in building out our data centers to support future gross margin expansion. Now, turning to guidance. We are pleased to raise our outlook for FY22. This outlook is based on our current assessment of the business environment. Specifically, it assumes that our direct and channel business will continue to grow, while our online business will be a headwind in the coming quarters as smaller customers and consumers adapt to the evolving environment. For the fourth quarter of FY22, we expect revenue to be in the range of $1.051 to $1.053 billion. We expect non-GAAP operating income to be in the range of $361 to $363 million. Our outlook for non-GAAP earnings per share is $1.06 to $1.07, based on approximately 307 million shares outstanding and a tax rate of approximately 10%. Due to our multi-year history of profitability, we have fully utilized our NOLs. We expect our tax rate to approximate the U.S. blended tax rate in FY23. For the full year of FY22, we expect revenue to be in the range of $4.079 to $4.081 billion, which would represent approximately 54% year-over-year growth, up from our previous guidance of 51% issued in August. We expect non-GAAP operating income to be in the range of approximately $1.598 to $1.6 billion, which would represent approximately 63% year-over-year growth. Our outlook for the non-GAAP earnings per share is $4.84 to $4.85, based on approximately 306 million shares outstanding. As always, Zoom is grateful to be a driving force enabling connection and collaboration worldwide with our high-quality, frictionless, and secure communications platform. Thank you to the entire Zoom team, our customers, our community, and our investors. Matt, please queue up our first question.
Our first question is from Sterling Auty with JP Morgan.
Yeah, thanks. Hi, guys. Eric, you mentioned kind of evolving into a communications company. And I'm wondering, as you think about the over 400 million business phone users that are on legacy technology, how do you anticipate capitalizing on that opportunity? Meaning, do you expect a big portion of those will end up coming on to either a video platform like Zoom, Zoom Phone, or will they start to just rely on their cell phones to make communication calls?
Yes, Sterling, that's a great question. As you see, right, in Q3, and a great customer like a carrier, right, and they expanded, to deploy the Zoom Phone, right, and it's not 100,000, tens of thousands deployment, right. So you look at the phone industry, right? I mean the clouds, based PBX industry. I think it's growing very well to replace legacy on-prem systems. Also, you look at those existing cloud-based phone providers, most of them developed technology stack many years ago. However, when those, especially for large enterprise customers, when they migrate from on-prem to cloud, they do not want to deploy as another solution because video and voice, those two are converged into one service. In particular, for those customers who already deployed Zoom video platform, essentially, technically, Zoom cloud-based PBX system already there. We just need to enable and configure that. Otherwise, you have two separate solutions. That's why we have a high confidence that every time in a lot of enterprise customers, they look at all those cloud-based phone solutions, Zoom always the best choice. That's why I think, the huge growth opportunity for all, for our, unified communication platform, video and voice together, and to capture the wave of this cloud migration from on-prem to cloud.
Got it. Thank you.
Thank you.
Question is from Parker Lane with Stifel.
Yeah, hi, thanks for taking my question. I was hoping you could dive into the Video Engagement Center a little bit, the initial reception that customers have had to that solution, and who do you ultimately envision the target customer will be here? Is it going to be more, lightweight, small business, medium-sized business that are looking for a contact center offering, or do you envision taking it upstream over time?
Yeah, this is a great question. So we were very excited, at Zoomtopia to announce our Zoom Video Engagement Center. Because, the reason why, we decided to invest resources on that is based on our customers' feedback. In terms of a growth trajectory, I would say it's very similar to what we did before for our Zoom Phone, right? You build a greater solution to leverage the same platform, and you can start from existing customers, SMB customers. Soon afterwards, you can, roll it out to a lot of enterprise customers. That's our, contact center, vision, right? Essentially, I think, this is a market, this contact center market is growing very well. However, a lot of enterprise customers, guess what? They still deploy on-prem solutions. For the next several years, I feel, the opportunity is huge for us, right? Especially customers deploy Zoom video and phone together as a natural extension for our unified communication platform to have very scalable, secure, and the same platform solution, which is our, the solution to the contact center space.
Got it. Thanks, Eric.
Oh, by the way, we do have quite a few, beta customers in the pipeline. So.
Next question is from Taz Koujalgi with Guggenheim.
Hey guys, can you hear me okay?
Yep.
I have a question for Kelly. Kelly, can you give us some more color on your mix across different products? We've had strong growth in Zoom Phone, Zoom Rooms for the last couple of quarters. Is the combination of Phone plus Rooms now more than 10%, or is that still below 10% of the overall business?
Sorry, is the combination of phone
and rooms? Or the non-meeting business, is that still less than 10, or has it crossed the 10% threshold?
Well, none of our product segments on their own is greater than 10% because it's likely that we would break that out if it were. If you add a few of them together, yes, there are a few of them. If you put them together, they would exceed greater than 10%, but on an individual basis, not any of them is greater than 10% at this point.
Thanks. Thank you.
Yep.
Next question is from Meta Marshall with Morgan Stanley.
Great, thanks. Wanted to ask just about the traction of customer ads. We've seen the customer ads slow down a little bit, and just wondering how you think about kind of sales and marketing resources, directing them more towards upsells, which is clearly showing a lot of traction, versus kind of new customer acquisition, and just how you think about that in the budgeting practice and how we should think about that going forward.
Yeah. So it's exactly the strategy that we've been planning for and thinking about, Meta. When you think about for Zoom Phone, for example, and Zoom Rooms, the strategy is to sell into the existing install base, which by definition just means these customers are going to grow larger and larger and contribute more over time. Depending on which segment of our business, the upmarket business, the majors and enterprises, right, they work on an account basis, so they get to retain those accounts, which is great because they build these long-term, multi-year relationships with them. They understand their needs and they continue to grow those accounts as they continue to see what they need. And then in the lower, like the mass market, we do have both expansion as well as acquisition teams, which work really well because that allows them to focus on growing, certain teams to grow, but other teams to be really out there hunting and continuing to add to our new logos. And then from a marketing perspective, we've grown so much in brand awareness that now we're really focusing on ensuring that everybody knows about Zoom meetings now also knows about Zoom Phone and Zoom Rooms and the other solutions that we could bring to bear for them.
Great, thanks.
Next question from Alex Zukin with Wolfe Research.
Hey guys, thanks for taking the question. One question, but it's multi-part, Kelly, and it's both for you. The question first is, after the summer, how should we think about the visibility in the model, particularly around churn with the sub 11 cohort? And then if we look at the guidance that you gave implicitly for billings, it looks like it's about a 6% year-over-year growth. If I look at the guidance for revenue, it looks like 19% growth. Maybe there's some upside to that. Maybe it's over 20. It's your toughest comp. But as investors start to look at next year, the street has you at 17%. So your implicit billings guide suggests the potential for single-digit growth. Is next quarter the trough that we start to build off of? I think that's a question I'm getting, at least from a lot of investors.
So in terms of, let's talk about the churn first, or the visibility. And as we talked about on the Q2 call, the historical trends that we've seen in our business have changed pretty dramatically. But what we saw as we came through kind of the second half of Q3 was that some of the churn that we were experiencing earlier in the quarter was really summer seasonality. And as we saw people move back towards vacations kind of in the back half of September, that we saw that strength and that usage returning. So these are all learnings that we will use now to apply to our modeling for FY23, as well as the fact that, remember, we showed you some of those detailed aging of the tenures of the cohorts at Analyst Day. And as those continue to age, that adds a lot of stability in that underlying business. And, by next year, over 50% of them are going to have moved beyond sort of that 15-month mark, which is where that churn really, really stabilizes. So that's really good news in terms of the volatility is going to continue to decrease over time. In terms of FY23, I know that's the big question on everybody's mind, but we are going to hold any comments in terms of FY23 guidance until Q4, at which point, of course, we'll be prepared to give Q1 and in full FY23 guidance.
Who's next?
Oh, sorry. Matt Stotler with William Blair. I was on mute.
Hi, Matt.
Hey, everybody. Good to see you. Thanks for taking the question. Maybe just one on the free user base. I know that you guys have always supported a number of free users and opened that up during the pandemic. You've talked previously about thinking through monetizing this base of users. Anything you can share in terms of, I guess, on one hand, an update on the size of that base, that potential opportunity, and then updates on how you're thinking about the ability to monetize that over time.
Eric, do you want to talk about monetization of free users over time?
Yeah, sure. So, Matt, first of all, when we started, right, free user base is always like a marketing platform, right, to promote our brand and give us a network, effectiveness of our service platform, so that's how we, introduced the free service premium and 40 minutes limitation. I think for now, given the brand recognition and given what had happened, last year, I think we got to, take a step back, look at our free user or online business, right? And essentially, on the one hand, we would like to double down our enterprise market because that business is growing extremely well. On the other hand, we got to be very creative to look at how we leverage our huge, free user installed base, right? All over the world, right? We started the advertisement program for free users from international market. And down the road, we are going to look at that in business as well, because not only do we focus on the, conversion rate, right, from free to paid. That's more like a traditional model, right? We got to be creative. The huge opportunity, right, and to think about how to monetize that free user base differently. I think that's I think our team put a lot of efforts on that, and that's something we are very excited.
Thank you.
Thank you, Matt.
Thanks, Matt.
Next question is from Siti Panigrahi with Mizuho.
Hey, thanks for taking my question. I just want to ask about your investment on go-to-market side. So as you are coming off of these two strong renewal quarters, what are the areas you are investing right now, and as you are normalizing growth rate? Is it certain regions or certain verticals? So could you give some kind of color on that?
Yeah, we certainly are continuing to invest in the sales organization, especially outside of the U.S. There, you've seen strong growth in international, and we really have the opportunity to continue to, leverage the brand awareness that's grown significantly, not only in the U.S. but also globally, and so that's a huge opportunity for us, as well as ensuring that we have the right sales team to support Zoom Events, Zoom Phone, and soon our Video Engagement Center as well. So those are all the areas of investment we're thinking about, especially for FY23.
Thank you.
Thank you, Siti.
Up next, we have Ryan McWilliams with Barclays.
Hey, good to see you guys again. Kelly, just on your existing customer growth, anything to call out there, maybe into the fourth quarter? And I would imagine meetings still makes up the bulk of your growth with existing customers, but anything to call out maybe in the changing mix between meetings versus phone and rooms with these existing customers? Thanks.
Yeah, I mean, Zoom Phone continues to be a really strong growth driver in general, especially as organizations are thinking about what's going to be their future of work strategy and enabling their employees to work from anywhere over time. And then Zoom Rooms, of course, is also really important consideration now as companies are thinking about welcoming their employees back in the office. The conference room strategy has become even more important than it was pre-pandemic, as I think it's unlikely, we'll all agree, it's unlikely that we're all going to be sitting around conference rooms together in the future. And so having any sort of a hybrid approach means that you need to make sure that it's inclusive. And the best way to do that is through the Zoom Rooms technology, things like Smart Gallery, which are really some of the opportunities that we're helping our customers solve today.
Yeah. So just quickly to add on what Kelly said, right? You look at the hybrid work, the conference room is extremely important. That's why you look at Zoom Rooms, right? It's uniquely positioned. It's much better than any other solution always there to support hybrid work. Not to mention the Zoom Events also can support, the new hybrid events, the services as well, right? That's why, huge opportunity for us to support a hybrid work in paradigm shift.
Yes.
Thanks, Ryan.
Next question is from Tyler Radke with Citi.
Hey everyone. Thanks for taking my question. Kelly, I wanted to ask you about just some of your comments on the churn rates. I guess first, did they perform in line with your expectations this quarter? Just kind of giving the moving pieces with summer seasonality. And then as you think about Q4, would you expect churn rates to get better because of less kind of summer seasonality in Europe? And then I just wanted to clarify, when you talk about the online business being a headwind, does that mean that you expect the online revenue to decline year over year, or does it just mean it's going to grow slower than the rest of the business?
So in terms of how the online churn performed in Q3, it performed better than our expectations coming in at the beginning of the quarter. And we were happy to see that it was more seasonality aligned rather than, true potential departures as people were, making other choices or going back to meeting in person more. So the seasonality nature of that was good news to see, and that rebounding in the middle to the back half of September. And then we expect Q4 to be relatively consistent with Q3 in terms of churn. However, We do see some impact from the holidays towards the end of December, and those holidays vary by the global location, but we do see kind of slowdowns based on that. In terms of what we expect from online going forwards, we do expect online revenue to grow more slowly than the direct and channel businesses as we look to the future, which is what we saw in Q3, for example, as well. But we'll give more specifics around that when we give guidance on the Q4 call.
Thank you.
Next question is from James Fish with Piper Sandler.
Hey guys, nice quarter. Just wanted to go back to Matt's question on advertising. First, how would this actually work? Can you give more color there? Would it be kind of banner within the application, pre or post video, and be more display-based advertising or performance-based? And then also just wanting to understand how much of this is really to try to prevent some of your more commercial and enterprise customers from lowering their number of meeting seats to free seats rather than just trying to monetize more of that online consumer SMB base. Thanks.
Yes, too, James. So, for now, we just focus on the free meetings, right? Meaning the free meeting hosts, right? We will have a meeting, all the free participants. Let's say if you and I join the meeting because we already paid, the either enterprise customer or paid seats, we will not, show the display ads, right? It's more like a post meeting attendee page, right? Because we do have, in some plans, but we want to start step by step, gradually, right? For now, show the display ads, the post attendee page from international market purely for the free, meetings, and try to learn, some experience. And again, we got to be creative. There's so many areas where we can be creative, right? Because you look at a daily meeting participant, in terms of number of free users, it's pretty healthy. Even for those, let's say users, right? Maybe they do not pay for our service anymore. They still use our service, right? That's why, the meaning Zoom still offers us great value to them. We got to think about how to monetize it differently. Again, this is something new for us, and we would like to explore more in the next few quarters.
Thanks, Eric.
Thank you.
Next question is from Rishi Jaluria with RBC.
Hey, Eric and Kelly, good to see you both. Thanks for taking my question. Just wanted to ask about Zoom Chat. I was really excited to see that launched at Zoomtopia 2 months ago, really kind of selling this vision of becoming this broader enterprise communication platform. I actually noticed that Zoom Chat is live. It's something people can deploy. I know it's an add-on feature, but can you give us any sense of color in terms of customers actually using it today, what that sort of usage within your existing customer base looks like, and what you're doing to actually drive usage of Zoom Chat among your customers to just make the whole platform more valuable for them? Thanks.
Yeah, Rishi, that's a great question. First of all, I can tell you, Zoom as a company, we were using our chat for a long time, and so many employees, we do enjoy that. And overall, this is a part of our overall UC platform vision because some customer, I think we did not do a good job to mention that, to promote that, because some customers even do not know that, right, before. But however, look at our chat usage, sorry, we did not publish that number yet. It's pretty healthy, not only for SMB individual users, but also enterprise customer. They deploy both video and phone and also Zoom Chat is one platform, right? And in terms of functionality, scalability, I think we have a high confidence. On the one hand, we do collaborate well with other chat solutions and we integrate very well. On the other hand, for some customers, they say they really want to deploy the solution for one vendor, for video, voice, and chat. We do have this flexibility, right? I think also, our team, we are innovating as well, right? Adding, more and more, very cool functionalities, right? As we announced at Zoomtopia. Again, this is something important for our overall UC platform, and we are going to invest more.
All right, wonderful. Thank you.
Thank you.
Our next question is from Karl Keirstead with UBS.
Okay, great. Maybe, Kelly, metrics like deferred revenues and RPO are certainly not the most important to watch with Zoom, but they can be indicative of changes in the business, so it's still important to keep an eye on them. And you made some color about DR and RPO next quarter that I'd love if you could elaborate. I think on DR, you mentioned that it'll grow mid-20s due to a cyclical decline in average remaining term of annual contracts. I'm not sure I totally understand what that means, so I'd love to ask for a clarification. And then likely on as well on RPO, you mentioned that we would see a shift back to long-term plans. I'm wondering if you could elaborate on that as well. Thanks so much.
Yes. So for deferred revenue, there's two things to remember, which is the seasonality trend of our renewals is that Q1 is the largest quarter for renewals and Q4 is the lowest. So in terms of new deferred coming onto the books, Q4 is the lowest quarter because of that, as well as the fact that Q1 is the largest quarter when deferred gets added to the balance sheet. But if they're annual contracts, by the time you get to Q4, most of that has already been amortized and recognized. There's only 25% of it, in theory, about left when you come into the quarter. So the combination of the fact that anything added in Q1 is almost fully amortized and will get refilled and renewed back at Q1, and the fact that Q4 is the lowest renewal quarter, those two things are what's driving this trend of of deferred, which I know is probably counterintuitive to any other company that you see, because of the seasonality that we have. So if you remember at Analyst Day, we showed you an actual chart that showed how our renewals lay out through the year, and that's what that illustrates. And so renewals, like deferred, is going to look the same. Collections is going to look the same because they're all, being built off of that trend. Does that make sense?
Yeah. And so the fact that DR growth would slow to mid-20s is due to what?
It's due to the fact that Q4 is our lowest renewal period, as well as all those annual renewals that came on in Q1, which is the biggest quarter, are now almost fully amortized and recognized.
Okay. That's helpful. Thank you on DR. Yeah. And on RPO, Kelly?
And then this has a strong impact on billings and RPO as well, because the same thing, like the adding to it, the billings and the collections are happening earlier in the quarter, and the remaining term is being amortized throughout the year. So it's the shortest amount of contract left during Q4.
Okay. I think I got it. Thanks for that clarification. I appreciate it.
You're very welcome.
Our next question is from Shebly Seyrafi with FBN Securities.
Yeah, thank you very much. So what is your latest thinking about possibly reviving the Five9 deal, such as with a higher price? And what's your current thinking about a build versus buy decision in the contact center market?
Yeah, Shelby, that's a great question. And unfortunately, Robin is not in the call. And otherwise, probably both of us, it's better for us to answer this question. But anyway, we look at everything from a customer perspective, right? Even this deal did not go through, however, and we still have many mutual customers, and we have a great integration with Five9. And also, I think, from that perspective, it's, everything same as before, right? But in terms of the deal, actually, nobody knows that. And let's see, we do not know. But also, as I mentioned earlier, right, and to have a full stack to support unified communication important. The customer, deployed Zoom Video already, in the middle of the process, they deploy Zoom Phone. They also asked about our strategy about, our contact center solution. And this reason why, we're adopting our video engagement center, which is our answer to the contact center solution. Anyway, I think, this is where we are now, but I'm so sorry, really hard to know, how to, re-engage or do the deal with Five9 because it's two public company, right? And and for now, we are doubling down on our video engagement center and also working together with all other, contact center solution providers like Five9, to offer a better integration, seamless, experience to our mutual customers.
Okay, thanks.
Thank you.
Next question is from Matt Van Vliet with BTIG.
Yeah, thanks for taking the question. I guess pertaining to the channel and especially with Zoom Phone, are you seeing much traction in terms of potential net new customers coming in where Zoom Phone is sort of the entree into that customer? or even as a part of initial deal, especially at the sort of mid-market enterprise level? Thanks.
Yeah, go ahead, okay.
Okay. So yes, we have absolutely seen the channel be a really important part and a really important growth driver for Zoom Phone, especially. This is why focusing on the channel both in the U.S. and growing that internationally is really an important aspect of our growth strategy for the long term here as well. And then we do have the ability, and we have seen customers that want to start to sell and to start with Zoom Phone first, and that has been a great opportunity. It's a small percentage of our customers that are starting that way, but it's a great opportunity for them if that's what they're interested in, is to get them in and get them used to Zoom and then expand over time in terms of understanding the full platform offering that we have.
Thank you.
Next question is from Matthew Nicknam with Deutsche Bank.
Hey, thanks for taking the question. I want to go back to the question before that was asked, not necessarily related to Five9, but having moved past that acquisition, maybe, Eric, how you're thinking about inorganic opportunities on either the UCaaS or the CCaaS front to really consolidate the market and expand your platform inorganically relative to some of the organic investments the company's talked about. Thanks.
Again, actually, Five9 is still a great, partner. Roman and their team is great. They still have a great and their friends, right? So we're still working together, right? To target the mutual customer, that's for sure. But regarding our growth, strategy, for, consolidated, UCaaS and CCaaS, first of all, I think, we are doing very well on UCaaS. In terms of the CCaaS, the reason why we announced the video engagement center, because of that, right? Because for some customers, they want to consolidate everything together, and we do have an offering. Also, how to accelerate that growth in addition to, allocating our own resources to grow that business organically, for sure, right? If there's any good, let's say, the technology, the platform for next generation, functionalities, very creative features, we are very open-minded, right? And Kelly has a big, and budget, right, to support that effort, right? Again, if you know of any other cool technology companies that can help us, for the beef up our investment on that front, we are very open-minded.
Great, thank you.
Thank you.
Next question is from Will Power with Baird.
Great. Good afternoon. So Eric, you referenced a number of, new customer wins. You really called out Carrier, I guess, in particular, and you suggested it was an extensive, process. So we'd really just love to better understand the importance of being able to bundle video and Zoom Phone for Carrier, and what in your estimation really kind of sets you apart from the other vendors, they were considering.
That's a great question. So, first of all, I'd like to take a step back to share with you how we grow our phone platform. It's not like some other cloud vendors, probably they target those traditional on-prem solutions. Our Zoom Phone growth, comes from not only for on-prem, the growth, but also for other, existing, cloud-based phone solutions. They probably also switch to us, right? And we have both, those customers coming from both, side. And inside of that, for a lot of enterprise customers, in particular for our existing Zoom video, customers, when they look at the phone, this very large enterprise customers, very complex, environment. Probably they have multiple on-premise solutions. They want to be very careful. They want to, partner with a company with a vision, with a reliability, security, plus they also want to make sure video and voice, those two can be converged. And after they test our service, they realize that based on the criteria, Zoom is the only solution, that can truly satisfy their needs. However, the process is pretty long because again, enterprise, phone deployment is very complex. And even if our existing customers, they want to be very careful, but after they go through the, RFP process, Zoom is the best position, right? I think we see that very often over the past several quarters. I think that will, probably the pattern, for the future, and growth as well. Because we have a high confidence as long as enterprise customers, no matter how complex their existing on-prem phone systems are, as long as it goes through the process, evaluate our solutions, I think we have high confidence they are going to go with our solution.
Thank you.
Thank you.
Next question is from Patrick Walravens with JMP.
Oh, great. Thank you. Hey, Eric, what would you say was your primary source of competitive differentiation as a video conferencing solution a while ago? And what would you say it is today as a communications platform?
So Patrick, that's a great question. When it comes to video conferencing itself, I would say, it sounds very easy, but however, it's really hard because it just works, right? And that's the reason why our customer like our platform. Even if some of the competitors try to add features, guess what? And, you got to make it work anytime, any device, right? Take this, the earning call, for example. How many of our competitors they dare to host earning call on this platform? Very few, right? The reason why we have a confidence, not only Zoom, but also some of our customers, like my great friend Jen, PagerDuty, they also hosted, earning calls on Zoom platform because of very reliable, great video audio quality, a lot of other very innovative features. Like early next year, we are going to announce our metaverse functionality. And Patrick, you can show up as your digital avatar, right? If you want to, right? I think on the one hand, I think this reliability, it works anywhere, anytime. And plus, always be the first vendor to come up with innovations. That's the reason why we're winning on that space. I think in the future, I would say more and more innovations and process supported the developer platform. And when you see platform, also will help us leapfrog our competitors. Again, it's not like you have a 50 or 100 person, you see, you can develop something similar. It's not like that. You need a huge investment to be on par with our platform.
It just works.
Exactly. It just works. It's just 3 words, but it's not that straightforward. It's pretty hard.
Next question is from Steve Enders with KeyBank.
Okay, great. Thanks for taking the question here. I just wanted to check back on the carrier deal and how that came together. It sounded like on the phone portion, it got a large portion of the seat base there. But I guess what would it take for Zoom Phone to be deployed wall to wall within that customer? And I guess what are kind of the learnings of that as you apply that to other customers that are considering Zoom Phone?
I think first of all, for the very large enterprise customers, in particular for those, customers who deployed multiple very complex on-prem solutions, the sales cycle for sure is longer, right? It's not only just one on-prem to cloud, right? Mm-hmm. It's multiple solutions, not to mention you need to support the global participant, right? And however, I think the Zoom solution is much better position. I think it normally take a little bit longer time, compared to the Zoom meeting platform deployment. I think we just need to focus on our product innovation and doubling down on our, go-to-market, and then actually more and more, very complex enterprise deployments like a carrier, they are going to migrate to Zoom platform. Again, I think it takes some time. Interestingly enough, some of the customers even do not know Zoom Phone platform, right? And however, after they, test our platform, Zoom solution indeed much better than any other cloud-based phone solutions. We have very, very high confidence. Yeah. Because again, it's not like hundreds of thousands. Those are tens of thousands, very complex, it's global footprint. It's, it does demonstrate our Zoom Phone capability.
Great. Thanks for taking the question here.
Thank you, Steve.
Next question is from Ittai Kidron with Oppenheimer.
Ittai, yeah. Go ahead.
Yeah. Hey guys, good to see you. I guess I was hoping to focus on the Global 2000. Clearly, that was a big part of your focus going forward, and that's where a lot of the sales resources have been invested in over the past year. Maybe you can give us an update on how penetrated are you at this point with the Global 2000, and has the competition changed within that category? And the reason I'm asking that Cisco clearly has made a lot of progress in the past year with WebEx, and they've vowed to be even more aggressive in protecting that turf, and clearly that is mainly their turf over there. How do you feel about the competitive landscape there? Win rates, what have changed? And, what can you say about progress to date with Global 2000s?
Maybe
you talk about competition first.
Yeah, you addressed the Global 2000. Yeah.
So in terms of the progress that we're making, we continue to make progress there. As we talked about earlier, devoting resources to international expansion and focus on this is still an opportunity. We're at still slightly under 20% of the global 2K that are spending more than $100,000 a year with us, which just means that there's a huge opportunity ahead for us.
So in terms of a competitive landscape, it just purely look at the video conferencing service. I think Zoom is a go-to platform. And I think, I really did not see any other, vendors, even for the platform mission, I built it before. I do not think, there's any competitor even, close to what we can offer. But in terms of, the unified communication as a platform, not only for phone, for video conferencing, but the meetings, CCAS, I think, I think for now we have a huge opportunity. You look at our phone growth, right? And essentially, especially for enterprise customers, they are not going to deploy, just multiple solutions from multiple vendors, very likely, 2 vendors, right? Probably for enterprise customers as a sort of standard. Zoom is very well positioned and compared to any other, the competitors. We did not see anything change because again, it's not like, you can cobble our features here and there. And, underlying technology, right, as that needs many years effort, right, and it's totally different architecture, reliability, security, and also all those innovations. That's the reason why I think, Zoom much better position. I really do not see any other competitors, right, and that's coming, in this space over the past 2 years. Yeah.
Very good. Thanks, guys.
Thank you.
Sorry.
Next question is from Ryan Koontz with Needham.
Thanks. One for Eric, if I could. With regards to the Ericsson acquisition of Vonage today to bring APIs to the 5G network, do you see this as disruptive to the CPaaS industry? And how does Zoom think about the evolution of video APIs with the programmable 5G core?
Yeah, I thought of the news last night, and I'm still digesting that news. First of all, I would say, congratulations, right, to Vonage's team, and the hard work is well paid off. And Ericsson is a great company. I think this is a great acquisition. And again, we're still digesting, this news, but from our perspective, and I think our vision is very, very clear, right, to focus on enterprise full usage stack. Video, voice, CCAS, events, Zoom Rooms to fully supported hybrid work, right? And, Ericsson is a great company and probably this will help them solidify the position for 5G and help them for their cloud vision as well. And yeah, that's probably pretty much, what I think about this deal.
Helpful. Thank you.
Thank you.
Next question is from Chaim Siegel with Elazar Advisors.
And you're on mute.
Here we go.
There we go.
Sorry about that. Oh, you hear me? Great. I wanted to just talk to you about, you started talking about sequential growth a couple of quarters ago, and you talked about it last quarter and just how you're thinking about that because this quarter was a little bit slower, but I don't know how much seasonality plays into it. And, I know you said you're not talking about next year, but, since we have these, crazy comparisons, I just wanted to know how to think about sequential growth and what's driving it.
Yeah. So I can reiterate what we said earlier in the prepared remarks is that, we continue to see strong growth in the direct and the channels business. And that grew at twice the rate of the online business is what we saw in Q3. And that the online business we expect to be a headwind as we're still having these online customers, which are the most volatile. Many of them are still on monthly contracts. And as they are adjusting to the environment and, figuring out how the future of work is going to be for them individually, we expect that to be the challenging headwind. And then in Q4, you'll see a little bit of holiday seasonality as we talked about too.
Okay. Thank you.
Yeah.
Next question is from Michael Turin with Wells Fargo.
Hey there. Thanks for squeezing me in. Nice to see everyone. I like the festive backgrounds. No one's mentioned that yet, but they're nice.
Oh, thank you.
Clearly coming off an extended period of impressive growth, I wanted to just ask around the what's next and how you balance staying efficient with staying aggressive. You're still spending around 6.5% on R&D. You have $5.5 billion in cash on the balance sheet. So with that profile, how do you balance staying on offense given all the market opportunities you have in front of you? And does the mindset shift at all as some of the growth rates moderate? Thank you.
Yeah, I mean, I can tell you that in terms of investing in areas like R&D and product specifically, we are still not even spending at the level we would like to be. Our target for that is approximately 10%, so they still have a ways to go. They've come a long way in terms of hiring and investing there, but we still have more opportunity to continue to expand both the product and the engineering teams. And then sales as well. Sales and marketing, we still see opportunity to continue to add sales capacity on a global basis. The areas that we're very, very thoughtful about adding additional investments in and wanting to do that in a very efficient way, of course, is COGS. We work very closely with Chami and his team to make sure that we're adding capacity. We want to make sure that we have the right capacity for our customers, but doing that as efficiently as possible. And then, of course, G&A. We want to do everything we can within our G&A functions to support our internal and external customers, but to do that also as efficiently as we can. So that's how we think about investing. So opportunities for growth still in R&D and sales, but trying to drive efficiency through COGS and G&A.
Helpful. Thank you.
Mm-hmm.
Our last question today is from Matthew Harrigan with Benchmark.
Oh, thank you. You pretty much elucidated the block and tackling issue, so I have one more fanciful question for you. I know you're pretty constructive on AR and VR in the longer term while recognizing all the rate limiting steps for consumer adoption. But with all the talk about the metaverse, all the buzz, and it really feels sometimes like people have no concept of even what it is, can you add any thoughts on that and what the potential opportunity for Zoom is over, say, a 3-5 year period? Thank you.
Yeah, Matt, that's a great question. First of all, we like Metaverse because our team already worked on that for a while. The reason why, our vision is to deliver a better, video conferencing experience, even than a face-to-face in-person meeting, right? And AR, VR is part of that. Our team already worked on that, right? How to get it there probably take many years effort. For now, this is a great concept, a great start, right? And like a digital avatar, right? We demonstrated that, functionality at Zoomtopia next year. We are going to have something like that. I think there's more step-by-step get there. Again, we already started it before, right? But we are not going to offer a hardware platform. We are going to partner with other hardware vendors, like Facebook, Microsoft, and any others, and we offer the software layer because that does fit very well to our vision. In the future, with that, AR or VR or Metaverse, maybe the future Metaverse, you and I can shake hands remotely, right? Seriously, right? I talked about it 3 years ago, and we already added resources before. That's why, we are very, very excited. And finally, the world talk about Metaverse. But guess what? We already started working on that for a while. Vision-wise, fits very well. That's why we are very excited. Better to macro questions, right? Where we are going to invest. We already invested that. We are going to double down on that because, again, fits very well to our company vision. And Metaverse will play a big role for our future innovation.
Thank you.
Thank you.
Eric, that was our last question, so back to you.
Oh, thank you all. Really appreciate your time. And I'd like to leverage this opportunity to thank all Zoom employees, all the customers, partners, and investors. Wish you all have a wonderful holiday season. Happy Thanksgiving. Thank you all for your time. I'm so grateful. Thank you.
Thank you.
Bye, everybody. Thank you.
Thanks, everybody.
Thank you.